Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. My guest today is Michael Pento, crowd favorite. Great to have him back. Today, we jump into the three big bubbles in the American economy: real estate, equities, and private credit. Why we're seeing such crazy overvaluations, but also how no politician right now can afford to let these bubbles burst because of the cross-contamination, meaning if you're in real estate, you're probably in equities and probably private credit. Nobody can allow this bubble to burst because of the systemic destruction it would cause on the economy. So therefore, what are they going to do? And what does that mean for the price of raw materials, the price of money, performance of the dollar, of gold, etc.? We get into all this stuff. Here is Michael Pento on the Jay Martin Show. Enjoy.
This is Jay Martin.
All right, here I am with Michael Pento. Michael, it's great to have you back on the show. Good to see you.
Thanks, Jay. Good to have you on.
So here's where I want to start. I've heard you talk about this triumvirate of bubbles that we're seeing right now in the U.S., where we've never seen all three bubbles form at the same time, meaning we've seen real estate bubbles, equity bubbles, and credit bubbles, obviously. But right now, all three seem to be peaking simultaneously, right? Value of home prices to income, highest it's ever been. Total U.S. equity market cap as a percent of GDP, highest it's ever been, and record high debt, right? Corporate, consumer, private, et cetera, et cetera. Have I wrapped that thesis accurately? Is that how you're approaching the economy right now? And if you could expand on that, that'd be a great place to start.
Well, yeah, I mean, I've been writing about this for quite some time. So you can't use asset bubbles as a timing tool, right, Jay? Excuse me. But if you look at things like the home price to income ratio, it's never been higher. And you throw in taxes and insurance, home prices are unaffordable. That's why it really bothers me when I heard some economists, there was one on Bloomberg. I don't know if I should mention his name or not. I hate to do that. And I don't mean to isolate Bloomberg because it's by no means idiosyncratic in being guilty. But I had one economist say, well, inflation's back in the bottle. The genie's back in the bottle. Inflation is quiescent. The battle with inflation has been vanquished. And what bothers me about that more than anything, Jay, is they're not looking at the salient issue. The salient issue is that the level of prices has bankrupted most of the middle class. The bottom four quintiles of the middle class have been destroyed by the level of inflation. The fact that it dropped from 9% at a rate of change basis to 3.2 on the core, year over year core, is not indicative of quiescence and panacea for the middle class. It just means that inflation has come down, but it's rising faster than the Fed's target. And excuse me, we have a little drink of water here. Maybe I'll clear that up. So,
yeah, no, that's cool. I mean, what you're saying there essentially is inflation maybe has dropped, prices have not. And so the unaffordable lifestyle of the bottom fourth quintile, as you put it, hasn't changed at all.
So this person who was on Bloomberg was saying there are anecdotal stories, anecdotal evidence, and he presented like his niece was eating ramen noodles in the store and in the grocery store, and that's high for her. And she's saying, well, inflation's still high. But this is a 1%er problem. Now, I'm one of the 1%. I mean, I don't want to get too personal, but I used to be in the middle class for a good part of my life. Mm-hmm. Their living standard, their purchasing power has been destroyed. And the fact that the Fed wants to pursue a higher rate of inflation that we have already, even though the level has destroyed the middle class and prices are rising at 3.2% on the core, that's not good enough. And that's why when people use metrics like, well, the consumer's debt to income ratio is quiescent. And they say the interest expenses on their debt is quiescent. So you look at household debt as a percentage of income, it came down from almost 100% in 2007 to it's like 79. Now, 79% is still very high, Jay. Still a very high ratio. But you're not taking into consideration is that the consumer has already been wiped out due to inflation. They cannot afford cars. They cannot afford insurance. They can't pay their taxes. So their cash flow situation has been eviscerated. And then you add on to that a historically very high debt service cost, not as high as it was in 2007, but historically high compared to the 60s, 70s, 80s, and 90s, still very high.
Yeah.
And you have a very stressed consumer. And that consumer, as you started the questioning off, and I just want to make sure after I cleared my throat, I can be able to completely answer your question, is that you see concurrently asset bubbles in homes, real estate market, total market cap of GDP, all-time record high. It's only 200%. Now, Jay, in 2007, it was 104% to GDP. It's much higher than it was in 2001 during the 2001 when the Nasdaq bubble burst. It's higher than it was in 1929. Much higher. And of course, that's not the only metric I look at. If you look at price to sales, it's through the roof. Historically, right. Through the roof, price to sales on the S&P 500. And you look at the CAPE ratio. Listen, we have the bubble in equities is undeniable. It's trading at 15 times next year's 21 times next year's earnings, which is incorporated a 15% earnings growth rate. How are you going to get 15% earnings growth when we have most likely going to have a large part of the Trump's tax cuts going to sunset into the end of 2025? People know that it's going to happen unless you have a sweep, a Democratic sweep or a Republican sweep. And there are very low odds of that happening. So you're not going to get that. So you're not going to get 15 earnings per share growth of 15%. And you're not going to get 21 times that, but you're getting that now. It's already priced in. And in a nominal GDP world of 4 or 5%, you're not going to get 15% earnings growth when you have higher taxes on those earnings. Corporate tax rates are going higher next year, at the end of next year. And then you have the credit bubble. You hit on it. If you look at corporate debt to GDP, record high. And there's also the shadow banking system. So you're talking about hedge funds and pension funds outside the banking system. They've gone bonkers issuing debt. If you look at even inside the banking system, collateralized loan obligations, CLOs, through the roof. Private credit, something that we never even heard of before, leading into the financial crisis. A $1.7 trillion just in, and what is private credit? It's like, you're a business, you can't get a loan, small business, you can't get a loan from the bank, you can't issue debt. So you go to the shadow banking system, they give you money. And this is a leveraged corporation, a leveraged business. It's a very, very risky loan. And there's now, almost a couple of $1 trillion of that kind of debt out there when there used to be nothing with no regulation. So we have three bubbles existing concurrently. And there's a very good reason to believe that even though the Fed cut 50 basis points, that does not equal a panacea.
Right. Yes. Okay. So, a follow-up question on this same topic. We covered kind of how the middle class has been affected by 9% persistent inflation. Yes, inflation's down, but prices aren't. So it really doesn't matter. Life's still unaffordable. But when you look at the asset bubbles, you talked about real estate, equities, and credit. There's got to be a lot of cross-contamination there because typically homeowners are also the ones who own equities. Individuals and private equity, right, are also homeowners. So if one goes, there's cash calls on the next. Would you see that as a domino event, or what's your take, Michael?
Yeah, you're 100% correct. I mean, the banking system is clinging on to their assets of mortgage-backed securities, commercial mortgage-backed securities, CLOs. So, if you have a recession, and I don't think that 50 basis points of a reduction in the overnight lending rate, interbank lending rate, is going to preclude the business cycle from ever happening again. In fact, if you look at past Fed rate cuts of 50 basis points, let's just look at the last 3 times that happened. So the Fed cut basically to zero starting in February of 2020, almost to zero right away during when the outbreak of COVID. Well, that didn't stop the S&P 500 from dropping by 35%. in a matter of weeks.
Right.
Okay, let's look at, okay, well, Mr. Pento, that's COVID. It's a bad example. Okay, we'll go to 2007. The Fed cut interest rates in 2007, in the summer of 2007, by 50 basis points.
Mm-hmm.
In the ensuing 2 years, the S&P 500 dropped by 50%, and home prices dropped by 33%.
Right.
Well, that was a once-in-a-lifetime credit bubble, housing bubble, so that is a bad example, Mr. Pento. Let's see. Okay, let's try this. Let's try 2001, when the Fed cut interest rates in the summer of 2001. They cut by 50 basis points, and 2 years later, the S&P dropped by 50%, and the NASDAQ dropped by 80%. So it's not a panacea. You have a lot of debt out there, a record amount of debt caused by 22 years of negative real Fed funds rate. That's unprecedented in history. That's why you have these asset bubbles. I mean, the real Fed funds rate was minus 8% not too long ago, a few years ago, minus 8. So if you look at the 20 years prior to that, you go back 40 years, we had a real positive Fed funds rate. But then we entered the fantasy island world of massive interest rate repression. And what do you do? And, Jay, when money's free, what do? You borrow it. Money was virtually free. In real terms, it was free. So I can go back. I can borrow money. What is the negative real Fed funds rate? What does that mean, Mr. Pento? I'll boil it down for you if you don't understand the concept. I can borrow money at close to 0%, and I could buy anything on earth, like gold or commodities or stocks or real estate, and make 8%, 9%, because that's what the inflation rate is. So it's a no-brainer. And when you borrow a lot of money, guess what? You get asset bubbles and you get a tremendous amount of debt. And that's what we're left with. And 22 years of that. And no one can convince me in the world. I don't know if you say, well, there's really not a housing bubble. Well, it's really not a stock bubble. There's really not a credit bubble. You could say that if you want to, but you're telling me that 22 years of free money didn't cause asset bubbles? I gave you all the facts if you don't believe it. Those are the facts. And there's a lot of cross-pollination there between the shadow banking system and the commercial bank lending system. They are all saturated in debt. And if you have a recession and the business cycle hasn't been repealed, there's going to be hell to pay.
Okay. Yes. So follow-up question on that. Most people I have on my show are completely aligned with what we've said thus far. There's crazy valuations in home prices, inequities, record consumer, private corporate debt. All of these things eventually come to a head. Now, calling the bursting of a bubble from a timing standpoint is impossible. So there's hot debates on that. But where I see three schools of thought on what happens next is this is what I want to ask you. Some people come on the show and they say, we're due for a 2008 style recession. Others come on the show and say, no, we're due for a 1929 style depression. And others still come on the show and say, no, this is the straw that will break the camel's back of the American empire. This is one we won't recover from. Do you land in any one of those camps, or do you have anything to share on those three theses that I hear quite often?
Okay. So here's my response. First of all, you can't time the market to the day of when it's going to top out. But I created a 20-point model that lets me know when to change. When do you want to go short the market? When do you want to really have max protection? Well, we haven't triggered it yet. I mean, we're long this market, and we have a very solid year performance-wise. But there are things you can look at, and I look myopically at credit spreads and financial conditions of highly stochastic things in my model that let me know when I should be worried. So I'll say that. Now, the question you asked me is, when do we know this is going to happen? Is that the basis of your question?
It's one, yeah, and then the second.
And then how bad? When do we know, and how bad does it get?
Yeah.
Okay. So when we know, I answered the first part of the question is when my model, the highly stochastic parts of my model, components of my model, when they trigger me to get defensive, will be when credit spreads start to blow out, and I'll get back to that in a second. And financial condition. Yeah. So how deep should this be? The natural force of things, I like to say the gravitational forces of deflation are extremely prevalent. It's like a black hole. So in other words, you have to have a lot of artificial stimuli. And by that, I mean monetary infusions, monetary injections to stop the gravitational forces from taking hold. So for instance, home prices need to drop by 40% to put them in historical line, not a reversion to the mean, not below that, just to revert to the mean. Home prices have to drop by 40%. Now, Jay, I probably don't have to tell you what would happen to the banking system if the value of mortgage-backed securities dropped by 40%. I'm talking about the shadow banking system and the commercial banking system. They would be wiped out. There wouldn't be a solvent pension plan or a solvent hedge fund on the planet practically. So that is where they should go. And coincidentally, maybe not so much, stock prices need to drop by 40%, closer to 45% now, just to bring them back to 100% of GDP. Assuming GDP doesn't drop, if home prices and stock prices don't drop and the credit bubble doesn't, and that's a bad assumption. So you're looking at a massive wipeout of the top 20% of that cohort of consumers who have been keeping the whole economy going. It's the top 20% that are keeping the spending going. I mean, the people that are buying houses for cash in Naples, Florida, where I live. That's the cohort that's keeping the economy going. Buying Bentleys for cash.
Right.
That's what's keeping the economy going forward. When you take 40% off of their assets, home prices, and 20, I read a statistic that, for example, about a year ago, 68% of all home purchases were purchased by investors. Investors own in aggregate about 25% of all homes. Now, you have a portfolio. If you're a corporation on Wall Street and you own a profile of thousands of homes, or even if you're an average Joe or above average Joe with 5 houses in your portfolio, and you've got a huge gain of 100% or so in those houses, and you can't rent them out anymore because people are losing their job and the cash flow dries up, and you say, I'm going to put 4 houses. I can't live in 5. Don't live in 1 at a time. I'm going to put 4 houses on the market. That's what's going to happen in droves, and home prices could crash. And home prices crash, your net worth disappears especially the top 20%. So you could have a severe the natural course of things is to have the gravitational forces of deflation reset all of these imbalances in the economy. Mm-hmm. Now, the Fed, and I got to tell you, there's no way Jerome Powell, I don't care what you think he is, a conservative, a Democrat, a free money guy, or a hard money guy, Paul Volcker, or is he, Miller? I don't know. I don't know how you feel about him. I can tell you the facts of how he acts. Okay. He is the one, I think he came in 2018. He dropped interest rates pre-COVID pretty substantially. So 2019, he was cutting interest rates before the virus was even known. And he kept buying mortgage-backed securities in 2022, in early 2022, after the COVID wasn't a problem and home prices were through the roof. And he's the one who reduced interest rates in emergency measure by 50 basis points last week.
Right.
Even though inflation, headline 2.5%, core 3.2%, is way above target, even though the unemployment rate is 4.2% when historically it's 5.7%, even though we have massive asset bubbles, credit spreads are tight, financial conditions easy, why is he cutting by emergency fee? I mean, this gentleman has proven through inculcation to Wall Street and me that he is there. So what's your point? What's my point? My point is that the Fed is not going to go quietly into the good night and just let the deflation fix everything. He's not going to do it. He's going to cut rates to zero, and he's going to go back into ZERP, and he's going to join hands with Janet Yellen and have some kind of monetization of helicopter money if they can get it through Congress. That's what's going to happen. And here's and I'll wrap up with this. I'll wrap up the answer to your question with this. Every other time they've done that, it's been successful in reflating asset prices because the Fed has been able to take down short-term interest rates. They control money markets. They can do that. They absolutely can control the interbank lending rate. But they don't control directly long-term interest rates. That's what they do not control. That's a function of credit quality of the United States government and inflation. And every other time in the past, they've gone through this. They've managed to successfully bring down both short-term and long-term rates. What if this time, precisely because we have $1 trillion in interest payments on the debt, precisely because we have $36 trillion in debt, precisely because we have 125% debt to GDP, precisely because we have not vanquished inflation, and we're going down the dangerous path of trying to reflate the economy when we haven't fixed the level of prices by any means whatsoever. What if interest rates on the long end rise? And that's what I think is not only possible, but probable and likely. And okay, if that's the case, if that's the case, you don't fix anything, because long-term interest rates are what mortgages are based off, and if you have a spike in long-term interest rates, it's going to be detrimental to the stock market too. So in other words, I'm saying there might not be anything the Fed can really do. Have you noticed, Jay, that since the Fed cut interest rates by 50 basis points, the long end of the bond market, the yield, has gone up and prices have gone down? Have you noticed that?
Okay, so let me unpack that a little bit. So we walked through 2001, 50% correction in S&P, 80% in NASDAQ, 2007, 50% correction in equities, 30% drop in home prices. Maybe you just answered it, Michael, but what's so different this time that we would at all costs prevent that kind of correction from occurring? Is it because of consolidation in these assets? I mean, you mentioned it, and we saw that today in home prices. Every hedge fund, every pension fund's going bust. Top 20% of the population's getting hurt massively. Is there too much power concentrated in that population to put pressure on the Fed to just enact policies to continue to kick this can down the road, at least until the next establishment? When Trump was in office in 4 years, he set a record for monetary expansion in 4 years. And then Biden smashed it, right? And he beat the 8-year record in only 4 years, right? Like, he just really ran with this. And so now I think, well, that's just precedent. That's the new precedent. Yeah. That's what that really is, right? Is that the case?
Yeah. So like I said, it's been inculcated to Wall Street. The playbook is, you talk about Bill Belichick maybe stealing signs, or some NFL coach knowing the plays. We know the Wall Street knows the playbook, and the playbook leads to 9% inflation. The Fed printed $4.5 trillion. They monetized almost $5 trillion of the helicopter money, which was $6 trillion unleashed by both the Trump and the Biden administration. $6 trillion of helicopter money. And that's not only, checks in the mail, it's enhanced unemployment and mortgage forbearance and all that other crap. Okay. That went on way too long. And you got 9%. I don't know. Since 1987, when Greenspan started this, Fed put, you've had the problem. The salient problem was deflation. It was, asset prices crumbling, and we had deflation. But I'm not sure this next time around, if we go back to ZERP, go back to QE, go back to helicopter money, everybody knows that's going to lead to 9% inflation or more. And the Fed has already told us that they have no real willingness or ability to fight disinflation. They have no toleration whatsoever for deflation, and they don't even like disinflation. So I think there's a very real danger that inflation can go well into the double digits next time around. And you just can't have a 3.7% 10-year note when you have inflation rising at 14, 15%. You just can't. So you have that inflation issue, and you also have the fact that in the next recession, the annual deficit will probably go between 4 and 6 trillion. It'll be about $5 trillion just because of automatic stabilizers that kick in. $5 trillion. I think the Fed's going to they'll feel obligated to buy most of that debt. So you're looking at stagflation as far as the eye can see, an intense period of stagflation. That's what I think is going to happen after this. However long and however deep this recession, depression, disinflation, deflation cycle lasts, I don't think it's going to be allowed to last very long because, like I said, Powell, I think reluctantly, in arrears, will cut to zero and start building up his balance sheet in reaction to the freezing of the credit markets, which I think is a very real possibility still. They haven't solved anything. They haven't really solved anything. I don't think 50 basis points, as I said, solved anything. We still have, by the way, quantitative tightening going on. The real Fed funds rate is still very much in positive territory. The yield curve just normalized, and normally when we had the longest inversion of the 2s and 10 yield spread in history, and this has been it has been a perfect indicator of a crash in GDP. So every time the yield curve hasn't been inverted in the past, we've had a recession, except for one time, it was 1965. And that's when GDP crashed from 10% to zero. So it was without exception that you've had a crash in GDP growth after a yield curve has been inverted, and the yield curve just normalized. And it's usually 3 to 6 months after that normalization that you see the recession begin. And recessions have brought the stock market down by 35 to 50% in the past, maybe, and sometimes even more. So I don't think we're out of the woods. This 50 basis points doesn't equal a panacea.
Right. Okay. So what's the play here, Michael? There's a couple directions I could see people thinking if we're heading back towards eventually, an establishment that's going to swing at all costs to avoid this recession, pushing us back into ZERP and et cetera, probably leading to double-digit inflation, then go towards assets. Like, even though valuations seem crazy, maybe that's the play. What do you look like right now in your portfolio?
So my portfolio, I have the IDEC portfolio, which is inflation, deflation, economic cycle. I look at the second derivative of inflation, and I look at the context of that second derivative of inflation in the context of economic growth. So I want to have a picture of inflation first and foremost, and then I superimpose the overall economic growth. And so we have been in a disinflation camp for about, a year and a half almost already. So that's sector 2, which is the second derivative is falling in inflation in the context of a weak economy. The real estate market is a very big part of the economy, and the real estate market is frozen. That just gives you one example. We also have a manufacturing recession. We have, I think, 21 of the last 22 months and when we have a manufacturing recession in this country, and we wiped out 4/5 of the purchasing power of the middle class. That's why you have, if you look at GDI, gross domestic income, much weaker than GDP. They're supposed to measure the same thing, but they're not congruent at all. We have a very weak economy in the context of disinflation. And as I said, I'm still positioned for that. So what does that mean? That's bond and bond proxies and gold. That's where we are, sector 2. Now, I think there's a salient chance we could go to sector 1, which is a recession and deflation, not just falling second derivative, but you actually see prices falling. That's the history. That could take up to, going from sector 2 to sector 1 sometimes takes 2 years or a year and a half. Mm-hmm. So I haven't written that possibility off, but I'm also keeping an eye out. I'm just sitting there saying, I'm, didactically saying we are going into a recession. There's nothing that can stop it. I mean, I believe that that's the case, but I have a model that I'm going to monitor every day and let me know if I'm correct. And so far, there's no reason to change. If you look at 5-year forward inflation expectations, if you look at the commodities complex, the currency, the level of the real Fed funds rate, quantitative tightening, the condition of the consumer, all those things lead me to believe that just because the Fed is going to go by another 50 basis points by the end of this year, taking the nominal rate down to 4.25 to 4.5, I don't think that solves all our problems. It's going to be too little. It's going to be too little, too late. And that's by the way, that's what's happened in the past. It's not an aberration for the Fed to start cutting interest rates, for Wall Street to claim, oh, it's a soft landing. I mean, they did that in 2007 and almost to the end, almost to the fall of 2008. I was on TV every week saying that this is a housing crisis that's going to lead to a recession. And they laughed at me and they said, oh, no, the Fed's got your back. Well, the Fed was slashing interest rates pretty dramatically. In fact, they cut them all the way to zero by the end of 2008. I hope you weren't buying stocks because the Fed was cutting rates. And the same thing happened in 2001. And like I said, in 2008, the issue was housing. It wasn't really a stock market bubble, and it wasn't really much of a credit bubble. It was a real estate bubble. And in 2000, it wasn't a real estate bubble, and it wasn't really a credit bubble. It was a NASDAQ bubble. It wasn't even much of a stock bubble. It was a NASDAQ bubble. We have 3 bubbles concurrently off the charts historically. I don't see how you get out of that so easily. That's my point. I mean, what I'm trying to say is don't be so quiescent and be so easily placated by the Fed's put this time around. Just pay attention. If you're in a 60-40 portfolio, you get wiped out on both ends, right? What you have now is if you're like, I have 60% of my portfolio in stocks, 40% in bonds. A lot of those 40% in bonds are in long duration bonds, zeros or maybe the TLT, 20-year plus. And I have 60% in like NVIDIA. and you think that's going to save you from a stagflationary recession, think again.
What are your thoughts on the commodities market right now? It's sectors of it look pretty appealing. You mentioned gold, right? And I think in this sort of crash environment, anything with a bid tends to get whacked, including gold, but it's still a pretty great lifeboat, safe haven asset class. And, the crashes we've discussed thus far, 2001, 2007, both of those led into pretty phenomenal commodities and gold markets. What's your take on the hard commodity sector?
Okay, so gold is not a commodity in my mind. Gold is a monetary metal. Gold is money. I'm not the first one to say that. So, but it's proven itself over and over again to be a monetary metal. It's pure money, honest money, real money. So it's not a base metal and it's not energy. It's money, like I said. So I'm the only commodity I'm long right now is gold. And gold has outperformed the S&P for 25 years. It's a quarter century. So not an idiosyncratic thing. It's not only outperformed the S&P, it's done so with much less risk. Its risk adjusted returns are through the roof. Sharpe ratios, very high. So if you look at past recessions, the worst place you could possibly be in is base metals and energy. They get wiped out, both the commodities and the equities. And even gold, and this is very truncated. So gold stocks are stocks, so they could get wiped out while gold is doing okay. But when, like you said, when push comes to shove, anything that's not nailed down that can be sold gets sold in a liquidity crisis. Now we're nowhere near that yet. Nowhere near that yet. So I'm staying with sector 2, which is disinflation, which is have falling nominal rates and falling real rates, is really good for gold. Now, the nominal part of that, well, you see the short-term nominal is falling, but the long-term is rising. So you're losing that part of it. But you still have, you have global chaos and in conflagrations all over the world. You've got a budget that's just out of control. If you look at both spending plans from both potential candidates, they're just, there's no hard money, balanced budget candidate out there. So, and gold loves runaway debt and deficits, because what do you have to do? You have to print the money to buy those. So you print money, you buy debt, prices go up, yields are capped, but the real interest rate plummets because you have to subtract inflation from your interest rate repression regime.
Yeah,
Gold loves that. Gold loves that. So I'm sticking with gold for now, and that's it. But like you said, and like I alluded to before, on the other side of this, which could be brutal. Yeah, you can time the market if you understand the rate of change of inflation. And the rate of change of inflation could skyrocket, but not now. The Fed isn't at zero. Real interest rates, if you look at the real Fed funds right now is still positive, like 200 basis points. If the Fed took interest rates to zero and they started quantitative easing and we started sending checks out to consumers, I would sell every single bond that I owned. I would short the bond market. I would sell anything that's even looks like a bond. But right now they're working, so stick with it, because the Fed and Treasury haven't done that yet. But they will, and that's my real fear. They will do that, and then when they change, or when when the market is anticipating that change to occur, but here's the news flash for you, or maybe not. The market is based on inside information, so the people who know what's going to happen will react ahead of time, and that's what they do. And my model picks up on that behavior, and I'll go along with them.
Can we unpack that for a minute? Because I think you're right, and it's a tough thing to sort of understand. But let's use like 2020 as an example. Things were starting to happen. It was very unclear for most people. But if you're somebody like a Stanley Druckenmiller, you've got resources that most people don't have. And you can have analysts and infectious disease experts on the ground in Wuhan getting the real picture months before anybody else is. You can deploy resources and act first. Is that, because that's honest business. It's just you got more resources to deploy. That's why the smart money moves and knows first. Is that accurate?
That is accurate. Also, let's just say that there was some kind of military action about to happen between Israel and Iran.
Yeah.
Do you think that it's possible that some of these generals and people in charge might want to capitalize on that? They would pile into shorts. They would pile into gold. They'd probably pile into energy. And people are like, gee, what's happening? Wait, well, my model picks up on that, and I'll go along with that.
Yeah.
And I don't know if is that insider information. You're going to get the SEC to go find somebody in Iran or Israel and arrest them. I don't know. But, it's a moot point. It doesn't matter to me.
Exactly.
The point of the matter is that I didn't lose money in the first quarter of 2020 because the highly stochastic parts of my model said, I don't know a bacteria from a virus. I don't really know. I understand the difference. One's living, one's not. One's DNA. But I'm not a scientist. I didn't know if the Wuhan virus, the COVID-19, was going to be the bubonic plague or a bad case of the sniffles. I had no clue. But what I did know is that the insiders were dumping what I needed to look at. And so I took protective action in the portfolio ahead of time. And the same thing is going to happen, before the vast majority of CMBS and mortgage-backed securities and hedge funds go bankrupt, people do know what's going to happen, pension plans. And before that happens, the insiders know, and they'll be taking action. and you won't hear it on CNBC. I don't think there's, the Federal Reserve is not going to come out and say, we're going to have a lot of bankruptcies this weekend, so I get ahead of it. Don't do it. Then don't rely on them. Look at the things that I look at, and you'll be better prepared. Not a guarantee, but at least it's better than, picking up the phone and say, hey, I'm getting wiped out here for the umpteenth time in history. I'm down 40% in my portfolio. And then somebody says, well, just hold, because I'm on the golf course and I'm your broker, and I'm out there trying to get more assets under management. Mm-hmm. And don't you know that you buy and hold, because market always comes back, Jay, right? Unless it's 1929 in the United States, it takes you 25 years to get back to normal, get back to even. Or if you happen to be living in China, you're still waiting. You're down like 45% since 2007. Or if you live in Japan, you're down, since 1989. You're still waiting to get back to even in nominal terms, not in real terms. So, no, it doesn't always come back right away. I mean, even in 2008, it took 5 years for
right.
and at my age, I'm at the ripe old age of 61 next week, but actually later this week. And I know you're going to tell me I don't look like that. Thank you for saying
look great,
that.
Man. Seriously. I see those arms, Michael.
You see the gun? You see the gun? I'm trying to look like you. At my age, I can't wait 5 years and lose half of my money and wait to hopefully get even, because sometimes it's not 5, sometimes it's 25, and sometimes it's like decades.
Right. Yeah. That makes sense. So, and I like how you unpack that a little bit, because it's not always conspiracy and deep state nonsense. Sometimes it is, but sometimes if you have all the money in the world, you are in that very top echelon of money management. You just have connections, and you use the example in Iran, maybe something's about to happen. Well, I can't call somebody in the Ministry of Defense. I can't call the top defense contractors in the world, but lots of people can. They can make those calls, right? And they can
do. And they do.
And of course they do. Of course they do. If I could, I would, right? Like, obviously. Yeah.
Well, I mean, It might be. I don't know if it's listen. I don't know if it's illegal or not to make a call to get inside information. I think it probably. If it isn't, it should be. If I'm like I manage, if I manage $1 trillion or whatever, and I can make a call to a general and find out the attack plans, the United States. I mean I invest on that or make that should damn well be illegal. But But I can show you. I've been doing this 33 years, and it rarely is a secret when something like that happens. It's like, oh wow, did you notice that all those puts that were bought just before this happened, just before 9/11 happened, someone was buying a lot of puts on the S&P 500.
Right. Yeah.
Think they knew something was going down?
Somebody did. All right. So a couple last questions for you, and then I know we got to wrap it up. Do you think the American public is beginning to realize that they are voting for currency debasement when you continue to elect politicians based on short-term promises, tax cuts, social systems, etc.? Like, the connection, I feel like, is in the infancy stages of being, because we're voting for this inflation. We're voting for currency debasement when we elect politicians based on the 2 and 4 year promises to make life better with government programs. What do you think?
Ooh, well, that's a great question. And usually when someone says it's a great question, they don't have a good answer. I'm gonna say that you're 100% correct. That's exactly what we're voting for. I think maybe 2% of the population has any damn idea what the Federal Reserve does. And I don't even know if they care. That's my answer. That's my cogent answer in a nutshell.
Yeah.
I don't think they know. I don't think they understand the process of creating Fed credit and what's it based off of, and why did we have a gold standard why do we have gold as money in the Constitution of the United States? I think it's Article 1, Section 10, I believe. I mean, why did we do that? And why did we abandon that? Why do we have a Federal Reserve? Who says 2% inflation is the magical panacea? Why? Yeah, right. Who gave the Fed the right to buy in 1913 they created something called a discount window. So a troubled bank can take assets and they can sell them to the Fed at a discount and a penalty rate. And that's how they can get liquidity. But I don't think that 1913, the charter of the Federal Reserve was to go out and buy corporate debt or mortgage-backed securities. And I don't think it was supposed to be done to the tune of trillions of dollars. I mean, who gave them that authority? I know, special Congress gave them special emergency, blah, blah, blah. I mean, isn't this the rule of law in this country? Well, the rule of law, unless you change the law. And when do you change the law? In an emergency. It's an emergency. Habeas corpus, gone. We don't need it. Civil War. Don't need it anymore. We don't need to fetter for the Fed from buying only treasuries because this is an emergency. So anything can happen at any time. Jay, is that it?
Yeah.
Pretty much, right?
Yeah. It's a fascinating story that 1913, on the heels of the Knickerbocker crisis, and JP Morgan gathered the bankers in his library and created the first bailout package sort of personally. Covertly allowed him to take over the American steel industry. It's a fascinating piece of history. Okay, very last question for you, and I know you got to jump. We might have covered this, but how do you factor in geopolitical considerations into your decision-making process? Do you abstain from headlines and say, this doesn't impact my thought process because I have my process and it works? Or are you paying attention to, the hot skirmishes that are erupting with a keen eye because this may impact how you adjust your portfolio? How do you take that input?
I don't look at headlines because they're highly stochastic and can lead you in the wrong direction. Let me just rephrase that. I do look at the headlines because I believe the headlines could lead to a change in the 20 component, one of the 20 components of my model, but only after those components change do I react.
I see.
I stick to the model. So if the model, if financial conditions are easing, even though the headlines really stink and are very scary, I don't care. And financial conditions and credit spreads, financial conditions are tightening and credit spreads are blowing out, the ones that I look at, but there's quiescence in the headlines, I don't care. I will react. That's how I look at things. So, you can come up with a lot of scenarios about the election, and I think it's going to be a divided between the White House and Congress. One of those houses will stay in one place, and maybe it'll be a divided government, and that means that the Trump tax cuts will probably go into sunset, most of them. I don't think they'll agree on something, but not all of them. So there's going to be a pretty big tax increase in corporations coming at the end of 25, most likely. But when does that matter? My opinion doesn't. I don't know. I don't know who's going to win the election, and I don't know what Congress is going to look like. But my model will let me know what to do and when to do it, and that's why I created it, so I can remove my emotions. Because listen, Jay, if I wanted to go on my emotions, I would be short the market for years. For years, I would own nothing but maybe T-bills, and I'd be short the market and gold. But that gold worked pretty well, and T-bills work. But if you're short the market, you've been wiped out. You would have nothing left.
Yeah.
So I don't react until my model. That's why I created the model. I didn't find it under a rug. I used my decades of experience to say, what happened leading up to major crises? I backtested it. What if I looked at this? Would that have given me a clue? Oh yeah, and that's why I assembled it, and that's what I use. Is it perfect? No, but it's better than, hey, how you doing on the golf? You doing well? Well, I'm down 30% this year. Don't worry, you market always comes back. 60-40 is the way to go. 60-40, Jay. 60-40 doesn't work. 2022 proved this beyond a doubt. If assets are in a bubble, if you're going to say, I'm going to find protection in the real estate market because the stock market's scary. No, I'm going to find protection in the bond market. Well, bond yields were almost zero. So, that part of your portfolio blew up like 50, 60%. In U.S. treasuries, traded like a small cap bankrupt pink sheet stock. Okay. And of course, and the stock portion went down to like 20 something percent. So when all of your assets are in a bubble, you can't find protection in any of that. I'm diversified. Well, you're diversified into 3 bubbles.
Right.
So you have to be a little more active.
Yeah.
A little more intelligent about your assets.
And I like the core lesson. If you have a way to remove your emotion from your decision making in the market, because that's what gets so many people in trouble, is they react right emotionally to mainly headlines or pundits or advice. Who knows? But step back, trust the process. Look, Michael, I really appreciate you coming on today. It's been awesome chatting with you, and we got to do this again soon because you're a blast and got lots to say. So thank you.
It's always a pleasure to be with you, Jay.